Equity markets have recovered from the lows in mid-October, reaching new highs for the year as fears of a global slowdown receded with improved economic data in recent weeks, while increased stimulus from global central banks was also supportive. Towards the end of November, global equities are up 11.1% in local currency, or 18% in euro terms year to date, while Eurozone bonds also remain strong, up 17.7% as speculation grows over possible further policy measures from the ECB. Global economic data has improved in recent weeks, helping to ease fears of a global slowdown which were evident in October. Most notably, global industrial production was up 0.8% month on month after disappointing through the autumn and is expected to remain firm in coming months. Regionally, US Q3 GDP grew 3.9% annualised, leaving growth over the 6 months to September at 4.1% annualised, the fastest growth over any 2 quarters since 2003. Eurozone GDP surprised positively, rising 0.2% quarter on quarter, while Q2 was revised higher to 0.1% quarter on quarter. Many Eurozone business sentiment surveys have begun to improve, although PMIs did slip further but remain in expansionary territory. The global economy should grow in the region of 3 to 3.5% in 2015 and should be supported by the recent fall in oil prices. Oil prices have fallen approximately 25% since the summer, despite tensions in the Middle East, as supplies have remained plentiful, facilitated by the continued growth in shale oil production in the US, the reopening of facilities in Libya, and the refusal of OPEC to cut production in an effort to protect market share. The fall in oil prices is a boost to consumer spending power as petrol and gasoline prices have fallen, and the recent drop in oil prices are estimated to improve global GDP growth by approximately 0.3% and by 0.4% in developed markets. Similarly, as seen in the chart, the weakness in oil prices has been a significant factor behind the low levels of global inflation, lowering inflation by approximately 0.3%. Despite asset purchases under QE3 ending in the US, global central banks' balance sheets will grow by about 15% in 2015, which should be supportive of economic growth and financial assets. In late October, the Bank of Japan announced it was increasing its asset purchases from a target of around 65 trillion yen per annum to 80 trillion yen per annum in response to inflation remaining well below its target of 2%. The ECB has confirmed it is planning to increase its balance sheet by €1 trillion to €3 trillion via LTROs and asset purchases, with increasing hints that this could involve sovereign bond purchases. Thus, the positive impact of central banks' balance sheet expansion on global economies and equity markets should remain a feature in 2015, although the expansion will have shifted from the US to Europe and Japan. Expectations over the timing of the first rate rises in the US, but particularly in the UK, have also been pushed out into the second half of 2015 as inflation remains low and central banks are wary of the risks of raising rates too early. Delays in rate rises maintain current accommodative monetary policies and should be positive for both equities and bonds. Looking into 2015, equity markets, we believe, continue to provide upside and are supported by a number of factors. Fundamentals in terms of a modestly improving global economic environment and rising earnings remain positive. Equity valuations are not stretched and are around fair value based on historic averages, although the economic, inflation and interest rate backdrop provide scope for some further rise in valuation multiples, while equities remain extremely attractive relative to other asset classes, particularly bonds. Monetary policies remain accommodative, with central banks' balance sheets continuing to expand even after the ending of QE3 in the US, while expectations for the timing of interest rate rises are being pushed out, facilitated by ongoing low levels of inflation. Flows into equities have been positive and are expected to remain so, given switching by investors into what is seen as a relatively attractive asset class, which should continue to benefit from improving fundamentals. In terms of Eurozone bonds, despite being at relatively low levels, upward pressure on yields should be limited by low inflation and recent ECB actions, with purchases of sovereign bonds by the ECB still a possibility. Markets, however, could be more volatile than they have been in recent years, with issues such as the exact timing of rate rises in the US and UK, political uncertainties and election cycles across the Eurozone and the UK, the outlook for growth in China, and perceived risks of deflation if inflation expectations fail to rise, potentially giving rise to periods of anxiety and volatile movements in markets from time to time.